This quote from Jesse Livermore reminds us that staying with the market's primary trend is the key to our investment success. In this video, we'll look at trends over multiple time frames and how longer-term trends can lead to better investment outcomes and give us peace of mind. Let's look at trends in price movement. A bullish trend has an upward slope and is composed of a series of higher highs and higher lows. Conversely, a bearish trend has a downward slope and is composed of a series of lower highs and lower lows. Bullish and bearish trends can occur across time frames. As a bullish cycle begins, we see that the short-term trend contains numerous counter trends that move opposite the direction of the long-term trend. The same phenomenon occurs in an intermediate trend, but is smoother. The primary trend unfolds over an even longer time frame and is the smoothest. When the bullish trend ends, we see the same patterns in reverse. The longer the time frame, the better for our psychology and bottom line. This is a daily chart that shows the short-term trend of the S&P. If you bought here in the beginning of the year, you currently have about an 8.3% loss from the peak on January the 26th. The psychology of loss is much more manageable over a longer-term time frame. We went through an extended period of sideways movement at the end of 2015 through the middle of 2016. If you identified the resumption of the bullish trend here in July of 2016 as price made a higher high, you gained almost 35% through January of 2018. This makes staying with the trend through what it currently appears to be a correction much easier. Looking over a very long-term time frame from 1928 through 2018 gives us even more information about our present investment prospects. In the gold boxes, you see long periods of price trading in a range before resuming a long-term bullish trend. At the bottom of each one of these boxes is a false breakdown. This is where the majority of investors decided to sell, and the bullish trend was able to begin again. These bullish trends are similar in duration to the sideways periods. At the upper right, you see that we just emerged from a period of 17 years of sideways movement. Looking at the gains following the previous periods tells us something about the prospects of our current investments, despite what looks like a current short-term correction. We all have an investment horizon and a time when we'll need to access our money. Looking at long-term time frames is helpful, but our time frame isn't infinite. Our minimum time horizon is 3 to 5 years, and our ideal time frame is to capture 80 to 90% of the current trend that may unfold over 15 plus years. Many times when people think of longer-term time frames, they think of a buy and hold investment strategy. Trend following avoids significant loss of capital that occurs with buy and hold. If you invested through the dot-com bust and the housing crisis, this will be a familiar chart. If you bought as price moved to the top of the dot-com bubble, you lost over 51% as price moved to the bottom of the box. If you bought in the run-up to the 2008 housing crisis, you lost over 57% from the peak to the false breakout below the bottom of the box, where most investors sold out. If you managed to hold through this entire period to 2013, you made no money for 13 years, while long-term trend following was able to capture gains and avoid the majority of the drawdowns. Investors using a buy and hold approach who needed to sell to access their funds have to ask themselves the question, how could I have let myself lose so much money? There are two significant biases at work. The first is the effect of green and red days in the market. Going back to 1928, on any given day. The market closed up 48% of the time and down 52% of the time. The odds of a green or red day are roughly 50-50. But those green days can fool us into staying invested even when the longer-term picture shows a clear downtrend. Let's look at how this can happen. Investors don't see the primary trend. They see parts of the intermediate trend. After a very long downtrend following an event such as the 2008 financial crisis, the market begins to turn up. Individual investors learn about this from media sources after the trend is well underway, and they buy late. On the following counter trend, they worry that the market is going to crash again, and they sell. On the next rise in the market, they're afraid to buy. They feel that they made the right choice on the next counter trend. Then they see that the market resumes and goes on to make new highs. Worried they're missing out, they finally buy in at exactly the wrong time. On the next drop, they remember what happened last time they sold early and think this time it's different. A counter trend convinces them that they're right, when it's actually their last chance to get out with a smaller loss. Declines are often sharper than rises, and on the next decline, their losses increase dramatically and they feel that they can't sell. They tell themselves that after all, it's not a loss unless you sell it. One more counter trend rally gives them a little more hope before the big drop. Unbeknownst to the buy and hold investor, this is the final stage of the crash, and it's a severe drop. When they can't take it anymore, they sell. Ironically, at the point where the individual investor can't take it anymore, the majority of other sellers feel the same way, and they all sell out in a final crescendo. To summarize Sir John Templeton's quote, "Bull markets are born on pessimism and die on euphoria." What explains this? That the majority of individual investors buy and sell at exact tops and bottoms can be explained in part by extrapolation error. At the top, the media is trumpeting stock market gains. New investors extrapolate based on the long rise in price that price will keep going up. Once the majority buy in, there's a lack of new buyers willing to pay higher prices, and the market falls. The same type of extrapolation creates new bull markets. The majority of buyers, suffering through a long decline, extrapolate that the market will continue to go down. Once the majority sell at lower and lower prices, supply dries up, and price begins to rise. If investors buy and sell at exactly the wrong time, how can we identify these important tops and bottoms? Our approach is evidence-based and produces one measure of the market from a broader series of data points. This helps us determine favorable entry points and stay with the primary trend as long as possible. This measurement of trend strength helps us determine probabilities of trend change and increases the odds of capturing as much of the trend profit as possible. This strategy is long-term trend following. As we've seen, key to our strategy is identification of changes in the primary trend. To visually demonstrate this strategy on the charts, we can use moving averages, which are an average of stock prices over a defined period of time. We'll be using moving averages with very long delays to showcase the primary trend. There are 252 trading days in a year and 5 trading days in a week. If we break down these time frames ranging from 6 months to a year, we get 4 moving averages that we can use for visualization of the primary trend. These moving averages are great visualization tools, but because of the long delays in their buy and sell signals, they're not part of our proprietary model. We're going to focus on weekly moving averages, the fastest being the 24-week moving average, which corresponds to 6 months, and the slowest being the 50-week moving average, which corresponds to 12 months. In bullish trends, price rises and the moving averages rise with price. In a bearish trend, price falls and the moving averages fall with price. Now let's use these moving averages to identify changes in the primary trend. In each of these charts, you can see that the moving averages on the left-hand side are in a bullish trend. When we get to the upper right-hand side of the chart, the moving averages roll over and reveal the start of a bearish trend. Looking at all of these charts, let's see if they helped us identify significant tops in the market. These are the same charts that we just looked at. You can see that the chart on the upper left is from the 2000 dot-com bubble. The chart on the lower left is from the global financial crisis. And the chart on the right is from the more recent 2015 through 2016 stock market sell-off. Let's see if these same moving averages can help reveal changes to a bearish trend. All of these charts start on the left-hand side with a bearish trend. Then the moving averages turn up and the bullish trend resumes. Let's see if these moving averages helped us identify significant bottoms. These are the same charts. You see that the chart on the upper left is the 2000 dot-com recovery. The chart on the lower left is the 2008 global financial crisis. And the chart on the right identified the bottom from the 2015 to 2016 stock market sell-off. Let's see if this visualization tool can help us deal with the most recent volatility in the stock market that we've experienced from February through early April. Are we about to crash, or is this a correction? The charts and the moving averages suggest that we're dealing with a temporary correction. Visualizing the primary trend is helpful in managing based on evidence versus emotion. If we take a weekly chart with the moving averages on the upper right and add price to it, we get the chart on the lower left. Price moves quickly and moving averages lag. Looking at the daily chart of price on the right, we can see just how much harder it is psychologically to manage without knowing that the primary trend is up. Risk and poor outcomes are more likely when you don't understand what is happening in the bigger picture. To underscore the losses that can occur from not understanding what's happening, look at this chart of the S&P from the 2008 global financial crisis. Remember that the long-term averages we're using to give a visualization of the concept are slower than price. You see that price declined much more quickly than the moving averages. If you used these averages as your only signal, you would have lost 18.5% from the peak, better than the additional 38.5% you would have lost by buying and holding to the bottom, but more than what we want from a trend-following model. Our goal is to buy as soon as possible when the primary trend changes and the trend is confirmed, and to sell as soon as possible after the primary trend reverses. This way we capture 80 to 90% of the primary trend change. Moving averages are simple, but simply too slow to accomplish our goal. Our model uses multiple submodels, including a long-term trend strength model, economic indicators, a liquidity model, a technical model, and a risk model, all of which are weighted and give us one measure of the health of the market in our market score. Based on our model's score from 0 to 100, we determine our allocation to growth and defensive assets. We then select assets by looking at where we are in the economic cycle and comparing their relative strength. No model can predict the future. We build a model based on how events are transmitted to the financial markets. We observe the empirical evidence to determine investment possibilities. We see if the market validates our hypothesis with price and execute with appropriate size and risk management. With a scientific, model-based approach to trend following, we can increase the probability of delivering satisfying returns. The The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Kaliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.